presentation.
Are you recording the video for every moment?
No, like 10 minutes, but
Cover everything. Yeah, I just want to make sure that everything is covered.
Great, hello everyone, and thanks so much for being here and having me, and also thanks to SIRE for this amazing presentation. I really appreciate it. Okay, so as you heard, my name is Stuart Brown, and I'm the CEO of a venture capital firm called Pycap. But Pycap is also an incubator that's registered with the federal government of Canada for the Startup Visa program. And actually, I have a few of my incubator members in the audience. So those of you who are affiliated with Pycap, let's please meet after the event or at some point during the networking session so we can get a photo together. Okay, so my presentation is about how venture capital firms invest. And I want to just do a quick poll of the audience before I get started. Who here is an entrepreneur? Okay, great. And among the entrepreneurs, who here has received funding from a venture capitalist before? Okay, great. And who here would like to receive funding from a venture capitalist? Okay, so we've all come to the right place for this presentation. So, in my whole journey in the world of venture capital for the last 10 or so years, I've met a ton of entrepreneurs, I've advised many, and I've noticed that achieving venture capital funding is often the aspiration of many entrepreneurs when they get started. But even though VC funding is such a large focus and driving point of how you develop your business, I've noticed that often entrepreneurs don't fully grasp or understand what a venture capital fund is or how VCs invest. And to be honest, you'd be forgiven for that because in the world of venture capital, it's often seen as us investors operating behind a veil, meaning we don't really disclose a lot of what we do unless we have a big success story. So you don't really understand possibly. There could be an asymmetry of information when you're pitching a VC. So it makes it a little bit more challenging to successfully close a round because in any sort of transaction, in order to come to an agreement, it's important for you to understand who the person is on the other side of the negotiation table and try to find out what their motivation is. Okay, so let's carry on how VCs invest. So firstly, I keep hearing this beep. Does anyone hear a beeping noise right now? Is there any way to stop the beeping noise? Okay, awesome, thanks. Okay, so what is a venture capital fund? Well, what's a fund? I'm sure you've all heard of a mutual fund or an ETF, an exchange traded fund, or possibly a hedge fund. But what actually is a fund? So a fund is an investment pool. So it's this pool of capital that investors put money into, and then there's a fund manager who manages the pool of capital. And that fund manager takes the capital and invests it into deals. We call them deal flow or deals. That's basically just the companies that we're looking to invest in. And then this pool ends up owning equity in each of the companies, and the investors, who we call LPs or limited partners who put money into the fund, they own what's called units of the fund, which represents ownership in equity of all of the companies that the fund invests into. So venture capitalists are unique among other type of fund managers. The things that make VCs quite unique fundamentally is that venture capitalists get heavily involved in the management of the companies which they invest in. They also target early stage companies, and they often target early stage companies that are in the tech industry, particularly software. So when you understand finance and investing, there's two pillars that you need to be cognizant of. It's the two fundamentals of finance, the two fundamentals of investing. And if you've spent enough time in the world of finance, you almost kind of look at life in regards to these two fundamental pillars. Each pillar starts with an R. Does anyone know what I'm talking about? What are the two R's that I'm talking about in the world of finance? Risk and return, that's right. So how does risk and return play into the selection process that a VC operates within in order to make an investment decision? So we already established that venture capitalists usually invest in early stage companies. We've established that within the early stage companies that VCs deploy capital into, it's predominantly in the tech industry, or even more specifically, mostly in software. How does that relate to risk and return? Like, why is it that VCs prefer to invest in software companies predominantly? Well, it's because software companies have less capital requirements up front in order to scale their business or grow their business. And because VCs are investing in early stage companies, given the fact that they are early stage, they are high risk. Why is an early stage company so much more risky than a later stage company? Can anyone help me understand?
There's no proof of concept here.
That's right, there's no proof of concept, there's no data, there's no history. The best indicator of a future result is looking at what happened historically. So if you invest in a company that's publicly traded, or a private equity firm that is later stage, manufacturing company, restaurant, whatever, you can extrapolate the data of the history of that company in operation to try to predict what might happen in the future. Finance investing is all about future potential. And so if you're able to look at the data from the history, like if it's a later stage company, you get to have all of this evidence and all of these indicators to show you that maybe there's a good chance that this company will continue to be successful and continue to grow and continue and hopefully provide you with a high return or a return. But when you don't have the history, when you don't have the data, when your company is starting out and creating a product that the world's never seen before, it's risky because you don't know if that product or that company is going to be successful. And within finance and investing, in order to justify investing in a very risky company,